Hi everyone. Many types of data have recently started flashing warnings, and they are warning us about potential sell-off in equities and also in some major commodities. So we decided to make this video to tell you to watch out and be careful. So today we'll go through all this data and show you what we have in mind. Before I start, however, keep in mind this video is not investment advice. And if I'm going to speak about specific financial instruments like futures, spreads, ETFs, options, and others, it is always just for educational purposes. I have prepared a few charts I want to show you, and I will start with equities. So here we go. The first chart shows the seasonal analysis for the S&P 500 futures. And you can notice that we are entering a seasonally unfavorable period because both the 5 and the 15-year curves are moving lower from now till the second half of March. And that's notable because generally stocks tend to trend up on a long-term horizon. You know, if you take a long period of time, generally the stock market trends higher. So when there is any kind of seasonally negative period on the averages, then it's really notable. So that's the message. However, when you take a look below at the statistics by month, you can see that both February and March are actually positive, above 50%. So that means the seasonal move lower was probably caused by a small number of really negative years. So that would make sense. I just want to remind you that trading stocks based just on seasonality is a really bad idea. So if you ignore this chart and just move on, then you will be fine. So let's take a look at something more important, which is the volatility. Here we have this S&P 500 futures, and on the bottom subchart is the VIX futures, specifically the continuous contango between the 7th and 4th VIX futures contract. So this is some artificial time series because it's made out of continuous contracts, and as they expire, then the curve or the chart switches to the next combination of contracts. You are probably familiar with this chart because we are using volatility a lot in our analysis. One thing I want to point out is that this is contango not on the near end of the VIX futures curve, but on the mid to, let's say, more distant part of the curve between the 7th and 4th contract. And let's notice this interesting divergence because the stocks are trending higher, but the contango has been trending lower since the middle of January. So that's the main reason why I'm really cautious right now about the stock market. You can open the same chart in the SpreadCharts app and analyze the data yourself, and you will find out why such a behavior is negative for stocks. So I won't delve into details and show you the historical parallels because you can do it yourself. But the point is, like I said, there is a very high chance of a correction in the stock market, another wave of sell-off. And I definitely would like to see this curve, the contango, to flip into backwardation, which means that this curve to move into negative territory before medium-term bottom in the stock market. So I'm not saying this is a coincident indicator. That would be wrong. So I'm not telling you that when this flips below 0, that would be the bottom. I'm just telling you that this is one of the necessary conditions I want to be fulfilled before we get another major bottom in the market. So I will continue to watch this carefully, and let's move to the next chart, which once again is not a timing indicator, but I told you, I'm not sure if it was in the videos or somewhere on Twitter, but I told definitely someone that I think that before we get the next wave of sell-off in the stock market, the dollar will turn first. And by dollar, I mean, for example, the dollar index will turn up before the stock market turns down. And I think this condition has been satisfied, because you can see the dollar index here. It's on an inverted scale, because I multiplied the price by -1 so that it correlates positively with stocks. And you can already see that the dollar is moving higher, which means that the curve is moving lower. So it is very likely that we have seen a short-term bottom on the dollar. So that would mean the stock market is ready to move lower. And now let's take a look at other types of data outside spread charts. Here I have two volatility indices. The top one is the VIX index. So that's something different than VIX futures you saw on one of the previous charts. And below is the VVIX index. Basically, the relationship between the VIX and the VVIX is the same as between the S&P 500 and VIX. Basically, VIX is a function of implied volatility on a range of options on S&P 500 index, and the VVIX is a measure of implied volatility on a range of options on the VIX index. So that's the relationship. Basically, VVIX shows the implied volatility of the options on the VIX itself. And you can see that the VIX has been going nowhere, or maybe trending slightly lower since December last year. But the VVIX turned around and started to move up at the beginning of this year. What does that mean? Well, the VIX options are becoming more expensive, because that's what the VVIX is telling you. And of course, that might not have a directional implications, because you can trade both put options and call options. And I no longer have data for VIX options like I used to do when I was creating those algorithmic strategies on them during my hedge fund days. But I would like to say, or I would say that the VIX is so low that it is unlikely there is demand for put options. On the other hand, I would say we are witnessing increasing demand and therefore price for the call options. And usually when there is an increasing demand for hedging through the VIX, then historically, if you go through the data, you will find out that a sell-off in the stock market and spike on the VIX usually followed. The big guys are simply starting to hedge for some reason. The next chart is similar to the previous one, yet totally different. It also shows data from the options market, but the data is not a function of option prices. Instead, it shows the put-call ratio, which is the volume or the ratio between the volume of put options and call options traded on each given day. So it doesn't matter at which prices or at which strikes these options were traded, just the amount of these options traded on a given day. And it's the equity put call ratio, so it's for options on individual stocks. And by the way, the actual data is visualized through these gray columns, and the blue curve is just some moving average to smooth it out. It doesn't really matter what period you use. Once again, the only reason I included the moving average is to, make sense of the inherently noisy data. And you can notice two things. First of all, the curve declined towards the bottom of the normal range when you take a look over the past year, which means that there is a complacency in the market. Nobody is hedged, which is a convenient time for stock market sell-off. And you can also notice that maybe, just maybe, this curve is starting to turn higher. So once again, that's the best time for a stock market sell-off. So this data supports the previous chart, the implied indices, the indices based on implied volatilities. So different kind of data, but the same message. But now let's get away from the options market. This is a different kind of indicator. It's basically a ratio between the high beta and low volatility stock prices. I created the ratio by simply using the ETFs holding these high beta and low volatility stocks. And the idea is pretty simple. When we are in a risk-on environment, the high beta stocks tend to outperform the general market, and especially the low volatility stocks, because low volatility stocks are naturally less risky than high beta stocks. On the other hand, when the market turns and we get a sell-off and panic, the high beta stocks are hit the most, while the low volatility stocks are affected the least. So in such a case, the ratio moves lower. And you can notice the nice uptrend on the ratio that corresponded to the uptrend in the stock market since the end of last year. But right now, the ratio has stopped moving higher, and maybe it is attempting to break down. It is not yet entirely clear if this is the local top, because we still have to see sharp move lower in the ratio, but once it happens it will be too late. So the point is, this is a convenient way to show the market sensitivity to the risk, to the risk attitude among the investors. That's the right word. So that's all. But the next chart is much more important, because it is a measure of stock market breadth. It's the so-called NIS index, and I use it regularly in our macro outlooks. So I won't delve into detail, because I'm sure I already did it in one of the older videos. But I would like to point out two things. The first thing is that the index got above 1,000 points, which is a lot. We can definitely say the market is overbought. But it is not a timing indicator. When the index got very high, that doesn't mean there has to be a sell-off. For example, you can look at the left part of the image, and you can see how the breadth was really awful for months before the stock market finally turned lower. So this is not a timing indicator, but it is important. And more important than the level itself, at least in my opinion, is the trend. And you can see the change in the trend a few weeks ago, because the index is moving lower. So that's bad. And I think this supports the theory that we will get a stock market sell-off soon. So, that was the breadth indicator. And the final chart shows the high yield corporate bonds. So it's kind of a measure similar to credit spreads, just inverse. Because when you create a credit spread, you take a yield on some basket of corporate bonds, and this time the risky high yield bonds, basically bonds of low quality companies that have to pay high yield for their bonds. And you subtract the risk-free yield, which is decided by the Federal Reserve, by the Fed interest rates, and you get a credit spread. So this is basically the inverse credit spread, because here you have the actual price of these bonds. Of course, it's hedged, so this is really similar, just inverse to the credit spread. And it's been in an uptrend since October that corresponded to the turnaround in the stock market and the uptrend since October. But I'm watching this chart very carefully right now because it does not signal any problem yet, but that might change soon. So I'm really watching carefully if this curve breaks lower below the trading range since the middle of January, because if the credit spreads start to go up, which means that this curve will start to move down, then that would be important negative signal for the equity. So I'm watching this one very carefully. Maybe the most important chart out of all those I showed you today, because it is not yet decided on this chart. This chart is still in uptrend, so it's kind of a missing piece in the puzzle. So that's why I'm watching it right now. So these were all the charts related to equities. I will show you a few more charts in a moment related to commodities, but some of you might ask, if we get a correction, how low the stock prices might fall. And to be honest, I don't know, and I really don't care, because as I told you before, it doesn't really make sense to set these targets. Basically, everybody who sets some target is just making things up, including ourselves. The difference is that we freely admit it, while someone else just develops complex theories, supporting his narrative and supporting his price targets. But the truth is, these price targets rarely work, and it's much better to always use the current market data to time the market. A better question might be if I would make use of this opportunity. And let's make one thing clear. We do not recommend anything to anybody. We are not making investment advice. Everybody is responsible for himself. But if I ask myself if I would hypothetically take use of this opportunity and short stocks, the answer is no. And the reason is that the risk reward is simply not attractive. Keep in mind, this is a short-term opportunity. I'm doing a short-term outlook, and it's well possible that the stocks will decline but then recover and move even higher above the 4,200 points. So I really don't like the odds here. We are in a market environment where directional bets simply don't pay off. We are in a chop, and I can read on Twitter how people are trying to time the market and trade the upswings and downswings, and I'm pretty sure that all of them are losing money, because these strategies, they don't make sense in a choppy environment like we are right now. So I'm personally very comfortable in my current position, which is holding T-bills. It's the strategy that we revealed to you in December last year, the best strategy for 2023, which was the US dollars and T-bills, because frankly, I'm holding the safest asset in the world, the US dollar, and I'm even getting paid for it, nearly 5% per year, in the forms of short-term T-bills. So I have really no desire leaving this position and trying to, trade some swings in the stock market with really low odds of success and uncertain risk reward. So I will definitely not leave my position. On the other hand, I think there will be some interesting medium-term opportunities once this correction goes through. But I will not talk about them here right now. I will keep this once the time is right, if we get the correction. So now let's take a look at the remaining charts. I wanted to show you. The first one is basically the US dollar. Here we have the chart we made many months ago when the dollar turned around. We told you that we had two targets in mind. The first one is here and the second one below, and we nailed this. Once again, if you wonder what advanced tools and algorithms we used to find these targets, then I simply made it up. That's the truth, and I was lucky. So that's how the targets work and how everybody sets their targets. So we are just dumb enough to admit it. But it's very likely the dollar has turned and it has reached a local low. I still can't rule out further decline towards the retest of this breakout, which would imply a move below 100, which is something I told you last year. But for now, the dollar seems to have turned, and once again, I'm personally feeling pretty comfortable holding the dollar compared to other assets, and especially dollar in form of T-bills. So we will see how this evolves, but if this was truly the local low and the dollar continues to trend higher, then it would be bad for stocks. We also alerted you in real time on our Twitter that dollar is most likely to turn higher because of these SOFR spreads between the SOFR futures, 1 month and 3 month SOFR futures, and we alerted you about the subsequent breakouts on these curves on our Twitter. So if you paid attention, then good for you. And finally, this chart is the Bloomberg Commodity Index. We explained it in the last article on our blog that we published at the end of January. We answered the question if the bear market is over. The answer was no. But the point I want to make is that we told you this was the most important chart back then. Not right now, but back then it was definitely the most important chart. And we explained why it is important on our Twitter and what the Bloomberg Commodity Index is. But the point is that it basically shows the behavior of some basket of commodities, and we told you that we expect, the index was consolidating. It was between 110 and 115, and we told you that we expect this this index to break lower below 110. This was explained here. To break below 110 and move towards 100, into the area around 100, not a precise target, but into this area. We still think that is true. We still think the index will get there, and as we told you, that would correspond to the short-term bounce on the dollar, which is already happening, a correction in gold and silver, which is already happening, and a correction in stocks, which is not yet happening. But we've been right about the dollar and gold and silver, so maybe we will be right also about the stocks. So we shall see. But as I said, and as I will zoom out, I expect the price to move at least into this area, and then we will reassess. It's fair to say that the correction on commodities would be bad for many people because, you know, there's a lot of optimism still about the crude oil and everything, especially among the oil bros. So I still think the crude oil will most likely move even lower. Even some other commodities like corn or soybeans come to my mind. These are quite vulnerable. So the further decline on this chart would just correspond to a broad correction in commodities, and so that's about it. And we are coming to the end of this video analysis. So the point is that there is a high risk of a sell-off in the stock market and in commodities, but it is not a good opportunity, and I would personally avoid this opportunity. So the point is, and the message of this video is to tell you to watch out and be careful, because although this is not a good trading opportunity, the truth is that being on the wrong side in the markets when or if the correction comes might be very unpleasant. So that's the message, to warn you about the recent evolution in the market data. So hopefully you will find this video interesting. Thank you for watching us, and see you next time.